All right, so chapter 4. Individual income tax overview, dependence, and filing status. All right, so going down here to the income tax formula for individuals. The beginning or the start of determining the tax liability of an individual taxpayer starts with gross income. So that's a term of art that we'll talk about. From gross income, you subtract 4 AGI deductions. 4 AGI is a term of art. Gross income minus 4 AGI deductions equals adjusted gross income. Very important for several reasons. AGI minus from AGI deductions equals taxable income. Okay, well, what's from AGI deductions? Well, quickly, it's just two things. It's the greater of either the standard deduction or itemized deductions. We'll talk about that. Most people in 2018 are going to take the standard deduction because it's going to be the greater of standard or itemized deductions. The other from AGI deduction is the deduction for qualified business income, if any. All right, so moving on. You take your taxable income and you multiply it times the tax rates to calculate your income tax liability. To that, you add any other taxes. That equals the total tax. And then from the total tax, you subtract any credits that the taxpayers do, and of course, any prepayments that the taxpayer has made. And that's going to equal either any remaining tax that's due or possibly, if they've overpaid, a refund. Individuals report their taxes on Form 1040 or a variation of 1040. So back to gross income. What is gross income? Well, it's the all-inclusive approach. It includes all realized income from whatever source derived and also wherever derived. If you're a U.S. citizen and you receive income in a separate country or a different country, you're required to report that income. Okay, so what is realized income? It's income that's generated in a transaction with another party. It changes the party's property rights. And so all realized income must be included in gross income unless specifically excluded or deferred by Congress. So exclusions and deferrals are a matter of congressional grace over their subjects. So for instance, you agree with your employer to provide services in return for an income, salary. That's a measurable change in property rights. You sell your car and receive cash. That's a measurable change in property rights. You sell stock for cash. That's a measurable change in property rights. But notice here, you can realize income even when you exchange your property for someone else's property, the other party's property. So it doesn't have to, you don't have to receive cash. Now, unless the income is specifically excluded or deferred, that realized income must be recognized, i.e. must be reported on your tax return as income. What's an example of excluded income? Well, the best example is municipal bond interest. Municipal bonds are bonds issued by state, county, and local governments. And so when they issue a bond, the bondholders receive interest payments. Those interest payments are excluded from income of the bondholders. Now, what if you own a federal bond? Well, that's not excluded, so you would have to include that in taxable income. Gain on the sale of personal residence up to a certain amount, if you meet all the requirements, is excluded from income. Certain items are deferred even though realized. If you sell something on an installment sale terms, then that income is deferred until you actually receive the installment payment. Something called like-kind exchanges, property that's exchanged for other like-kind property, which is again a term of art, is excluded or deferred, excuse me. Certain types of gross income are treated differently than other types of gross income for purposes of computing the taxpayer's taxable income and income tax liability. And so certain types of income are taxed either at no amount because they're tax exempt, or if they're deferred, they're not taxed in the current year, they're taxed in some future year. The other types of character you can have, and the main type of character of income or loss, is ordinary. If it is an ordinary income or loss item, it's taxed at ordinary rates. Certainly that's true for income. For losses, if you have an ordinary loss, you may be able to take all the loss. The second type of character is capital in character. Now, capital items that we're talking about here are called capital assets. And So the capital gain and loss that comes from the sale of capital assets has a different character from, let's say, ordinary income items. Well, what is a capital asset? A capital asset is any asset other than accounts receivable, inventory, and other assets held for sale, or assets used in a trade or business, including supplies. So your personal use automobile, your residence, stocks, bonds, that painting that you're holding as a collector's item. Those are capital assets. And so when you sell those items, you can recognize a gain if you sell it for more than its basis on another term of art, basis, that we'll talk about. And when you sell a capital item for a capital gain, how that's treated is dependent upon how long you've held that capital asset. If you've held it for 1 year or less, it's considered a short-term capital gain, and it's treated as an ordinary income item, so it's taxed at ordinary rates, just like wages. If you hold an asset, a capital asset, more than 1 year and then sell it, it's considered a long-term capital gain, and the gain is treated preferentially, and so it would be taxed at either 0, 15, or 20%, depending on the taxpayer's taxable income. Well, what if you sell a capital asset for a loss? Well, regardless of whether or not you hold that property for more than 1 year or less than 1 year, you get to deduct in that particular tax year $3,000, up to $3,000 of the capital loss. Well, what if your capital loss was greater than $3,000? Well, you get to carry forward any additional excess capital loss. So let's say you had a capital loss, either short-term or long-term or both, of $10,000. You'd get to take $3,000 in the year of the loss, $3,000 that next year, $3,000 that next year, and then $1,000 the year after that. So bottom line is capital gains and losses, well, capital gains are taxed at preferential rates. Now going back, they took this out of sequence. Qualified dividends are also taxed at preferential rates. Qualified dividends arise when taxpayers own shares of stock. Often these corporations that they hold stock in pay dividends to the shareholders. And so when these taxpayers receive these cash dividends, these dividends are taxed at preferential rates of either 0, 15, or 20%, depending on the taxpayer's income level. So bottom line is you have different types of income taxed at different rates. Tax exempt, not taxed at all. Tax deferred, not taxable in the current year. It's taxed sometime later. Ordinary, taxed at ordinary rates. Qualified dividends, taxed at preferential rates. Capital gains, taxed at preferential rates. Losses, you get to take losses. Now, capital gains, if they're short term, are taxed at ordinary rates, so no benefit there. All right, so moving on to our deductions. What is a deduction for AGI? Well, it's called by tax practitioners as deductions above the line. The reason they call it above the line is it's a dollar for dollar reduction in income in determining adjusted gross income, AGI. So what are common AGI deductions? Well, as long up to 2018, here pre-2019, alimony paid as long as the divorce decree that orders the alimony is prior to 2019, alimony paid is an AGI, for AGI deduction. Rental and royalty expenses. Contribution to qualified retirement accounts. Contributions or premiums on health insurance for self-employed individuals. If you had to lump all these four AGI deductions, for the most part, they are somehow business related. Not all of them, though. Alimony is certainly not the case. Deductions from AGI, so these are considered below the line, meaning they're after determining AGI. And so they're deducted from adjusted gross income to determine taxable income. And so again, it's the greater of the standard deduction or itemized deductions. What are these itemized deductions? Well, usually the make or break case, and again, the standard deduction is pretty large. It's almost doubled over last year. But and this is a bit of a trade-off. Taxpayers are no longer able to claim personal and dependent exemptions. So, a bit of a trade-off there. So for married filing jointly, last year the standard deduction was $12,700. Well, this year it's $24,000. So most taxpayers are going to claim the standard deduction because they're just not going to have enough itemized deductions to make it where that's greater than the standard deduction. However, they still might, because some of the most common itemized deductions are mortgage interest. If you're early on in your mortgage and you're paying a pretty big amount of mortgage interest, that could be greater than the standard deduction if you include that along with property taxes paid and or any state income taxes. Now there's a limit on that we'll look at in future chapters as well, so you're somewhat limited in how much you can pay in state income taxes as well as other things. So here are your standard deduction amounts. Note here that married filing separately and single are exactly half of married filing jointly and qualifying widow or widower. And then you have that middle ground for head of household, which again, qualifying widow or widower and head of household have different meanings in order to qualify. There's also additional standard deductions for certain people of certain ages and certain eyesight. As we pointed out, the U.S. uses a progressive tax rate schedule for federal taxes. And so we've kind of looked at the rate schedules for 2018. Some items are taxed at preferential rates, and those amounts have to be taken out when you are determining your ordinary income tax amount. And so you have to calculate the long-term capital gains and qualified dividends, the amount of taxes you pay on those separately from ordinary income items. There are other taxes that a taxpayer may have to pay, such as the alternative minimum tax if they have a lot of itemized deductions. There's this alternate calculation of tax that has to be run. Self-employment taxes if you are self-employed. If you're a high-income individual, you might be subject to the 3.8% net investment income tax and the 0.9% additional Medicare tax. Tax credits reduce the tax liability of the taxpayer dollar for dollar. Tax prepayments. The U.S. tax system is a pay-as-you-go system. If you work for your employer, they're going to take taxes out of your paycheck every pay period. And so, for the most part, your taxes at the end of the year are paid, as long as you're withholding enough. Now, of course, if you prepay too much, then you're basically loaning money to the federal government, interest free. So it's a good idea to try to zero that out at the end of the year. Make sure that you're not having too much withheld, just enough to meet your tax liability. Of course, if you do exceed the amount that you owe in prepayments, you're going to receive a refund. All right, next thing we want to talk about here is who qualifies as a taxpayer's dependent. So I'll do that after taking a short break.